Interest rates, the heartbeat of financial markets. They influence how we spend, invest, and value every asset in the global economy. When interest rates change, they set off a ripple effect, shifting bond prices, stock valuations, real estate demand, and even currency movements. In this video, we'll understand, step by step, how this one metric, interest rates, can reshape the value of everything you trade or invest in. Welcome to the Option Guy, where finance meets insight. It all begins with the central bank. Institutions like the Federal Reserve or the Reserve Bank of India decide the policy rate, the rate at which they lend to commercial banks. Raising this rate makes borrowing expensive and slows economic activity. Lowering it makes money cheaper and stimulates growth. Through this simple tool, central banks control inflation, stabilize currencies, and guide market liquidity, effectively steering the financial ecosystem. The bond market reacts instantly to interest rate changes. Bonds are promises to pay fixed income over time. When new bonds offer higher yields due to rising interest rates, existing bonds with lower coupons lose appeal, causing their market prices to fall. This is the classic inverse relationship between bond prices and yields. It's the first concept every CFA or FRM candidate must master. When interest rates rise, bond prices fall, and vice versa. Interest rates affect stock prices through something called the discounted cash flow model. The value of any stock equals the present value of its future cash flows, discounted by a rate that includes the risk-free rate, which is directly linked to interest rates. When rates rise, the discount rate increases, making future profits less valuable today. Result? Stock valuations decline, especially for growth companies that rely on distant future earnings. This is why equity markets often pull back when central banks hike rates. Real estate runs on credit. Higher interest rates mean more expensive mortgages, reducing affordability and slowing down property demand. Developers face costlier financing, and investors seek higher rental yields to justify purchases. As a result, property prices tend to decline when rates rise. Conversely, lower rates make borrowing cheaper, fueling housing demand and real estate growth. In essence, interest rates set the rhythm of real estate cycles. Commodities tell a fascinating story. Take gold, it doesn't yield interest. So, when interest rates rise, investors prefer earning yield elsewhere, making gold less attractive. On the other hand, oil depends on economic activity. When higher rates slow growth, oil demand falls, leading to softer prices. Both assets react differently, gold through monetary logic, oil through macroeconomic demand, but both are tied to the same heartbeat, interest rates. In the foreign exchange market, interest rates are the gravity that moves money across borders. When a country's rates rise, it attracts foreign investors seeking higher yields, strengthening its currency. When rates fall, investors move their money elsewhere, weakening it. This dynamic fuels the carry trade, borrowing in low-rate currencies and investing in high-rate ones. Understanding this mechanism is vital for FRM professionals analyzing global capital flow risks. For investors and analysts, interest rates aren't just theory, they shape portfolio strategy. Rising rates hurt long-duration bonds and high-growth equities but can benefit value stocks and financials. Gold often loses shine, while currencies of high-yielding economies strengthen. Real estate may cool, but short-term debt instruments become attractive again. The real skill lies in understanding correlation shifts, how all assets respond together to the changing tide of rates. In today's interconnected world, interest rates in one country can ripple through others. A U.S. rate hike can strengthen the dollar, draw capital from emerging markets, and trigger currency pressure abroad. This is the global web of finance, interconnected, interdependent, and constantly evolving with every central bank decision. Understanding these links is what turns financial knowledge into true strategic insight. Interest rates are more than economic tools, they're the rhythm that drives the global market orchestra. From the yield curve to the stock market, from gold to the rupee, every asset dances to the beat of rates. I'm the option guy, helping you decode the forces that move markets. If you found this video valuable, hit like, share it with your CFA or FRM peers, and subscribe for more deep, insightful content. Because understanding markets is not just about watching prices, it's about seeing the connections behind them.